Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today, I've got a question here. This is from the Discord channel of the Finding Value website. So someone on here had asked the question. It looks like he's looking for a video, and I think it's a pretty good question. The question is, it says, at Finding Value, can you talk more about how rising rates are a result, not the cause of current market conditions? Everyone is screaming about rate hikes being the pin, being the pin to the bubble. And I've heard it for so long, it's hard to get my head thinking the other direction. Can you break this down in simpler terms in a video? I think many would appreciate it. So let's go back to that question or that statement that he says. It says, talk about rising rates as a result, not the cause of current market conditions. So what is the driver? What is the driver of inflation? So when I go back, it is the increase in the money supply. What is the driver of the increase of the money supply? I mean, this is literally like digging into the root cause of the problem. Well, it would be loans into the system. Loaning into the system creates an expansion of the money supply in a fractional reserve lending system. A fractional reserve lending system, and what that is banks make loans and they only keep a fraction of the reserve back. If it's a 10% reserve ratio, they keep 10% back. If it's less than 10%, then they keep less than 10%. The other money that's created, the other above the 10% is created in the system. It is expanded into the system. Money is created from nothing. So they put in an entry in their books and money's created, goes out into the system. And that expansion in the money system comes from residential real estate, the loaning against residential real estate. Now, the big expansion of the loans comes from new loans being generated against new homes. So the volume of homes being generated and built in the system is expansionary. That is what we've seen in history. So one could say, by knowing this information, that the demographic of this country in America prices assets around the world. That is what the conclusion is if you keep digging deeper and deeper and deeper and deeper. So what that means is the interaction of the demographic and the real estate market. The real estate market has to build more homes as a demographic is larger, comes into home buying years. And remember, this is all home buying years. It has nothing to do with the demographic being done today. It has nothing to do with Gen Z. It has everything to do with the millennials, the bigger demographic. Now, the rate of change in population growth over time is the rate of change in the housing market, depending on how the market fluctuates with respect to the population. So what do I mean by all this? If the population has a dramatic rate increase, it goes up a lot, and that big generation comes through home buying years, the rate of change will impact the rate of change of housing starts. Now, this time, and I'm not saying this time is different, but it is different. This time coming through, we have not only a larger demographic on the demand side, we have supply side problems. What do I mean by supply side problems? Well, this is not just the rate of change in the demographic, it's the rate of change in new housing starts to meet the demand of the new demographic. And it depends on how many new homes have to be built. And there's a bunch of things that we can use to verify this stuff. So when the demographic comes in and it's a great rate of change, you're going to see a couple of things in the market to validate, not verify, but to validate that I'm right. So what would we see if we have a shortage of homes in the market? We would see rent prices increase and home prices all increase at the same time. We would see the new home starts kick up. And that is kind of the validation metrics that you use, and you see your inventory drop to very low levels, And if this demographic that's coming, which is already, we're in it right now, we're at the beginning of the demographic of this big rate of change move. And you can see it on the website that I posted, the demographics and all that stuff, that big rate of change. Yeah, I should definitely write a book about this. But that rate of change is going to impact the housing market in a very quick manner. The rate of change is what puts that inflation into the system. It just dumps it all in the system because you've got all these loans going into the system against much higher cost homes and also all these new homes coming in at greater and greater quantities above the average. Your housing loan volume is your inflation. Now, that is the market condition. I just described the market conditions. Now, how does that impact interest rates? What it does is when the inflation rate goes way up, it puts a real negative yield on bonds. So bonds pay some low interest rate, whatever it is, 2%, 1%, 0.3%, whatever duration, the length of the loan is. And then you get this inflation comes way up above it. So if the inflation rate's, I'm just going to make up a number, 9%, and your bond pays 1%, you're getting a negative 8% return. That's called a real negative rate. That real negative rate forces bond sellers to sell their bonds because they are losing purchasing power by holding those bonds. Once those bond sellers start to sell, what it does is it raises the interest rate. It raises the interest rate because you have more sellers than buyers. And the only way that that can clear itself is if the interest rate goes up. So the interest rate going up will put all existing bonds in the market, put them at a loss. They'll start going down in value because why would you hold? So bonds get priced off of the interest rate. In a falling interest rate environment, bond prices go up. In a rising interest rate environment, bond prices go down to account for the rising yield on newer bond products. And the pricing is already set in whatever bond prices are at this current time. So if the price went down, the bond value goes up. And then as the interest rate goes back up, bond prices fall back down. And it's just basically a discounting mechanism for the future cash flows of that bond. That's what it is. So the interest rate chases inflation. It chases the market conditions. Now, if you go back to what I said, it's the demographic interacting with the real estate market. If it's that interaction, then we should be looking at the demand and supply of that situation. And what happens is if you're really short in your homes, your rent prices will start rocketing. And then what happens is people will say, well, if rent prices are so much higher than buying, well, I'll just buy the house. And then it will continually push rent prices and home prices higher like this. And then they'll start buying new homes. And if new homes are very expensive because of inflation, because of all of these things to get the raw materials in there, that will also push prices higher. And that's exactly where we're at right now. We're in an increasing price environment, moving at the fastest pace it ever has. What is that telling us about the demographic? It's telling us that the chart that I posted on my website of the raw data is validating that we have the largest imbalance at this time. And we're also validating where we are in the cycle of a recovery phase to expansion phase transition. So we're transitioning into that expansion phase right now. And the largest market deficits are when the demographic comes into home buying years, that large demographic, and then eats up the inventory and dwindles it down to nothing. So the market condition of the supply-demand imbalance in real estate is impacting interest rates through inflation. So as inflation remains and we continue to go up, we will continue to put pressure on the bond market to sell off and increase interest rates until another force comes and acts upon it called massive yield curve control, or QE. And I don't know what they can do because these forces will be at play in ever greater quantities over the next 4 or 5 years. Continually. This isn't going to let off. I don't know if interest rates are going to resolve the problem. The problem is in demand and supply of homes. And the demographic is a larger demographic, and the supply could very well be restrained to some degree. We're also entering this market with a deficit of a massive amount of homes. So we're not just hitting this with a deficit of homes. We're hitting this with a supply problem of deficit of homes and a demand that's larger. Those two combined are interacting with each other for the largest home appreciation that we've ever seen. And I think that's going to continue. I don't think rates are going to slow it down until I see some sort of evidence that the inventory is getting rebuilt. And I don't know how you're going to rebuild the inventory unless you build new homes. If you have more and more demand for homes and you haven't built the deficit back, well, the situation is just going to get worse. It's not going to get better. Interest rates don't build homes. And I don't want to hear about these people who say they have this chart. They say, oh, it's not structurally a deficit. It is, because people just don't sell their house. We're going to have sellers, and those homes have to be in the right locations. So you can't just use those numbers. They're not right. If you use that, and I'm not trying to, prop up my side of the argument. It's just their side is completely wrong. It doesn't make logical sense. But the interest rate is reacting to that demand supply imbalance in real estate. It's not a driver of it. Lower interest rates doesn't drive a demographic. It doesn't. I mean, sure, it may pull forward some buys. I don't know. It might have pulled me. Not really. I don't think it really pulls forward any sort of demand. I think it's all malarkey. Malarkey, that's what it is. People buy homes when they're ready to buy a house. And the demographic is coming, which is much larger than it was before. And if you look at the demographic change, it's a very steep curve, which means we have a large demographic coming into home buying years, which is going to be very inflationary, just like it was in the 1970s. And just like the 1980, early 80s, all the way till 2018, I would say, 2018, that whole decline in interest rates was demographic driven, in my opinion. So what's coming is this large inflationary period for probably another 5 to 10 years. I'd say 5 to 8 years would be a really good bet, somewhere in that time frame. And I don't think it's going to let up. I think it will be continuous, because what's going to happen is it's going to continually put pressure on the housing market. And if you look at history, the market conditions, the housing market is what causes these recession, depression type movements. Now, we could have a pullback in stocks. I totally agree with that. But I don't think it's going to be a blowout crash like it would with the housing market blowing out, like the Depression, like 1980, that type of movement. And in 1980, the interest rate went up higher and higher and higher and higher, and the demographic ran out. It wasn't because the interest rates ran out. It was because the demographic ran out of the supply-demand balance for real estate. The inventory was back up, and I can show you all sorts of data on that. If I were to look at, let me pull it up here real quick because I've got it. That is the real estate one. Let me get me out of the way. This is what happened. The demographic came up. It was a big surge from 67-ish to 1973 is kind of that demographic surge. Then we came back with a smaller demographic, and then another surge happened. But the inventories both came up to 10 months. The demographic ran out. And it came back down to, quote, normal levels. They overbuilt during these two periods. And we overbuilt in this period over here. We're not in that same scenario. We are coming into a larger demographic, and the inventories are at lows. So the interest rates are just reacting to this. Interest rates went up here, but it was a smaller demographic, and it was a smaller rate of change. We have a bigger demographic and a bigger rate of change coming, and that's why the inventory levels are the lowest we've ever seen. So I think that interest rates will not solve the problem. That's what I think. Interest rates don't build homes. Interest rates are reacting to the situation. Bondholders are selling based off of the situations in the real estate market. And if they thought a recession was coming, what they would be positioning for is a recession. They'd be buying bonds. They're not buying bonds, they're selling bonds. They're agreeing with what I've got. And they probably know what I know. I hope they know what I know. But they know firsthand that there's probably not foreclosures coming. There's probably none of that stuff coming. And that the forbearance doesn't exist because the banks would be positioning for it because they have insider information. They know all that information. They're the ones writing the loans. They're the ones that can see what's in forbearance. They know the ones that are going to foreclose. They already know all that stuff. And if they know that, then why are interest rates still going up? Because they're selling bonds. They're getting the heck out of here. They know it's bad. They probably know it's so bad that they're going to go buy a bunch of homes because they know it's a huge shortage. That's what BlackRock and all these other ones are doing. They know what's up. So, in my opinion, the interest rates are just reacting. They're not setting the tone, so to speak. They're not. Whenever you look at home prices go up with interest rates. Home prices go up first, and then interest rates catch up and follow. Interest rates don't go down, and home prices don't go rocketing higher. Interest rates only go down when nobody wants to loan any money out because you have a bubble. You have prices and credit being destroyed. So that's what I mean by rising interest rates are a result of market conditions. They are not the trend setter. And that's what I've got for today, guys. And I think all of these commodities go up because of liquidity in the system. It's not because of the supply-demand imbalances. I mean, that will make it worse. That's where money's going to flow the most. You'll see the largest imbalances where money runs to those first, I think. And if you get both of these aligning, which we will in the mid-2020s, this is going to be the most insane commodity bull market you've ever seen because of that alignment. Because of liquidity coming from the housing market and the demographics of the millennials coming through home buying years and the supply side shortages of all these different materials. It's something that I am thankful for experiencing because this doesn't happen in anyone's lifetime. It hasn't happened yet. And it's going to happen here very soon. And I think it will be the largest bull market in commodities that anyone's ever experienced. Bigger than probably the 70s, because the 70s had copious amounts of materials all around them in this world. These materials are getting a lot more scarce, and they're a lot harder and longer to bring online, I think. And along with the energy crisis, I think the crisis will be larger than the one we had in the 1970s. So I think it's just going to take more time to resolve itself, put it that way. So I think the imbalances are bigger. I think that the stakes are higher, and it's going to take longer to fix all this. So it means it's got a lot longer time to squeeze and compress prices higher. But that's what I've got. If you want to see the demographic, the demographic that I've written all up, it's on my Finding Value website. Platinum membership can see that. Sign up, you can see it. It's my latest post. And yeah, that's what I've got. Give me a thumbs up for the content. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.